right, day 531. Let me see if I can share my screen here so you guys can see everything I'm looking at. Okay, 1 second. I'm gonna double check on YouTube because for some reason my live streams on Riverside have not been going into YouTube. So let's double check. Give me 1 second. Okay, it's working. Great. So today I want to talk about a few things. So if you guys don't follow this guy's name is Housingwire on Logan Motoshami. He's the analyst that I've been following for quite a while, and I learned a ton from him about what exactly can you expect and when can you expect interest rates to potentially fall lower and what are the implications. So I listened to the latest podcast he did for about 24, 25 minutes. And here's what I learned, right? And I've been following this for a while, but a couple things. The first thing is you have to understand what affects the interest rates. And if you're asking the question, hey, why aren't interest rates going lower right now? There's all this fears of recession and tariffs being thrown around. So many things going on. Okay. Now, the interest rate and what I learned from Logan is affected by two primary things. One is the interest rate on the 10-year treasury yield. And the second is the spread between the 10-year yield and the 30-year mortgage interest rates. Now, historically, that spread has been about 1.5 to 2%, but it's gone as high as 3%. And that's when we saw interest rates in the eights, essentially. And if you look at the stats for the past 12 months for the 10-year yield, you can see that it peaked maybe a year ago around 4.6, 4.8. It dropped to its lows about 3.6, 3.5, maybe even. And then it went back up to 4.8 just a couple months ago. And now it's at 4.274. Here's why it's important. If you've been following what we've been doing for the past couple of months, right? We've been looking at properties, especially if you're looking to the BRRRR strategy, buy, rehab, rent, refinance, repeat. Well, the goal of that strategy is for you to take back out all your initial invested capital. Let's use an example. If you buy a property for $20,000 cash and you spend $50,000 cash renovating it, so now you're all in 20 to buy, 50 to renovate, so you're all in 70 grand, okay? But you're able to make that property worth $100,000. Well, now you can go get a debt service coverage ratio loan, a DSCR loan, for 70% of the home's value. So you can go take back out 70% of 100 grand, which is 70,000. Take the same 70 grand back out that you invested that's tax free, and you do it over and over again by putting it into the next deal. Right, the next deal you might buy for $30,000 and run it for $40,000 again. But the problem is, what's it contingent upon? It's really dependent on that $100,000, the ARV, the after repair value that you're using for your assumptions to be accurate. But you have to understand when you are at your lows, right? Let's say you're buying a property, let's say you're refinancing a property today. So you might have bought the property in September and October, and you're refinancing today. The comparable properties that were sold that you might be using for your ARV estimates, or that the appraiser by the lender that's hired by the lender that's the third party that they're using to appraise your property. They might be looking at comps that were sold in September and October when interest rates were lower, so the monthly payment is lower, which drives up affordability and drives up the prices of your homes. Versus now, when interest rates are a little bit higher, right, about half a point, if you're buying a property today cash, and so that means you're probably running refinancing 3 6 months down the road at the minimum after you renovate it and get a tenant placed. Well, what happens? In that scenario, you might be looking at properties that are being sold today, but interest rates are higher. When interest rates are higher, your monthly payment is higher, which drives down your affordability and puts downward pressure on your prices. So you might say, hey, instead of buying that property for 20 grand and renovating it for 50 grand, I might have to buy it for 10 grand and renovate for 50 so that I can only have my total cash invested 60 grand. Just in case that property is only not worth 100, maybe it's worth $90,000. So that's why interest rates matter so much, especially when it comes to factoring in your buying decisions. Now, here's what I want you to understand, right? this 10-year yield has come down from the 4.7, 4.8-ish all the way down to 4.27. Now, it's not just affected by what the Federal Reserve is doing. It's very heavily affected by the labor market. Now, in the past, right, you see, and right now I have the Federal Reserve comments here. This is the news release from Governor Michelle Bowman. Michelle Bowman has, I think she's getting nominated to be like the vice chair of the Federal Reserve. So this is really important. But I will highlight one thing. Right now, she says, hey, although the FOMC has been focused on lowering inflation in the past few years, as we continue to make progress on approaching a 2% target, I expect that the labor market, and economic activity will become a larger factor in the FOMC's policy discussions. So I think the last inflation reading we got was like either 2.8 or 3.1. So they're almost near the target of 2%. So they don't really have an excuse to not lower rates anymore, right? So now they're focusing on the labor. So what does that mean? I've been following Logan, and I think he said that once your unemployment claims on a 4-week rolling average get to about 300 or $340,000, 340,000 people, 4-week running average, that's when you see the labor market break. And once that breaks, the 10-year yield bond market is going to be faster than the Fed, right? You're going to see this 10-year treasury yield drop. So right now he's forecasting right between 3.75 to 4.25. So they're staying within that channel. The only way it can go lower, the only way that interest rates can go lower is one of the spread narrows, which it already has gotten better. So that's why you see interest rate in the mid sixes now. But the only way it can go lower below 3.75 is probably if the labor market breaks. So you have to be starting to learn how to track what's happening in the labor market, what's happening with the unemployment claims, because that's going to affect the 10-year yield more. And this is going to be a leading indicator on what's happening in the treasury rate. So right now it's starting to trend upwards, right? Pay attention, see what happens. If all of a sudden it's like 300,000 people losing their jobs, okay, pay attention. That might mean interest rates are going lower. So you want to start getting ahead of the game when that happens, okay? Be very, very mindful of what's happening in the market. All right. I learned all this from listening to Housingwire and Logan Motoshami. I learned a ton from him, but I learned how to take what he's saying, but also apply it to how I'm looking at projects, to how I'm looking at real estate deals. Again, this is not investment advice. I'm not soliciting any investments on this call. I just simply want to take some time to explain to you what's really happening in the 10-year yield, right? I'm not analyzing a deal today. I think it was really important to go beyond just a deal to try to explain all the different forces that are pulling at each other. Because sometimes we think about, oh, the Federal Reserve is cutting rates, or the Federal Reserve is not cutting rates. You have to know that the 30-year mortgage interest rates is not affected by the Federal Reserve necessarily. It's much more affected by the 10-year Treasury yield. Now, can the comments for the Federal Reserve affect the bond market? Absolutely, it can. If they say, hey, we expect to get cut interest rates 10 times in the next 12 months, well, now the interest rate for 10-year might drop. But if the labor market starts breaking before the Federal Reserve cuts their rates, guess what happens? The labor market is going to start breaking. The 10-year yield is going to start moving lower a lot faster than the Federal Reserve. And you can get ahead of it instead of waiting like everybody else for the Federal Reserve to lower the rates. You would have been ahead of the game because you're paying attention to what's happening to the 10-year yield. All right. Hopefully this was helpful, everybody. I thought this was just a good concept to go over. This was just something that I never was explained to by anybody. I had to just learn this on my own through some other podcasts, through following other people, and just absorbing all this information. And I just try to break down what I spent the last 2.5 years, 3 years learning and compress it into 10 minutes for you. So hopefully this is helpful, everybody. If you guys have any comments, if you guys like content like this, leave a comment down below. I'm trying to become a new person, not just focusing on underwriting, because we have over 500 videos on how to underwrite deals. I want to make sure I explain the concept today. All right. Have an amazing Thursday, everybody. I'll see y'all tomorrow for day 533. Have a good one. Talk to you tomorrow.